There we go.
Okay.
Hey, everybody. Welcome. Thanks everyone for joining. We have our man, Brian Shannon. Brian, thanks for joining us. How's it going?
Hey, great. It's going great. Thanks for having me on your guys' show again. You guys do awesome work putting education out there, and I'm honored to be on again.
I appreciate it, man. It means a lot. So I'll let you take it away, man. Go ahead.
Okay, so these slides, I did a presentation in Florida on Saturday, and I'm sorry, I always do fresh slides. So they're fresh through last Friday, but we're going to get the opportunity at the end here to also take a look at some live charts, hopefully. I'm happy to stick around, a little bit longer for questions and that sort of thing, and look at stocks, look at the market, and that sort of thing. So let's take a look. We're here to talk about the anchored volume weighted average price today, and we'll do a little bit of education on it. It's my hope that everyone understands at least the very basics of it. But one of the questions I get most often is where to set the anchor. Here's what we're going to cover today. What is the volume weighted average price, just on a real higher level? The anchoring bias and why it's important that we anchor the volume weighted average price and what it means to various participants, investors and traders, when we see these volume weighted average price levels hit, why they offer resistance as they're below a declining one, and why they tend to act as support. And then we're going to, once we go through that just general introduction to it, we're going to talk about specific anchor points. And then we will, hopefully, have time to look at some live charts and how to make money. So, the volume weighted average price is combined of the three most important things. One is price, the very most important thing I always say. Only price pays. It's how we keep score. We can, look at MACD, stochastics, even volume weighted average price levels. I mean, they're there to assist us in one thing. Our job is to make money. And at the end of the day, there's only one way to know if we did that right, and that is to look at the price action. And it's only price pays. So volume represents the emotional commitment and level of participation in a market. How quickly do people want in or out of a stock? And then time, of course, is the most subjective. Time is relative. I tend to be my ideal time frame is a swing trade, and some people define that differently. So I'll tell you how I define it is if the market allowed me to hold it for more than one day because I didn't get stopped out, then my swing trades will be anywhere from 2 days to ideally up to 3 weeks. The average is probably 4 to 7 market days. Is what the market usually allows me. And we'll talk about what I mean by what the market allows. But the way that the volume weighted average price combines these three components, I think, is the most perfect way to look at psychology from an event. And it's really also we're talking about, of course, is supply and demand. That's all we're ever talking about when we're talking about the market. We tend to confuse it with news reports, what the Fed is doing, and that stuff's all important. And though it is important, but it's also, just the catalyst often. But it's not, people always say, well, why was the market up today? And everyone searches for, well, it was the Fed minutes. Oh, well, no, it was because, the Fed is doing this, or because oil was down and Europe was doing this, and all these fancy stories. But at the end of the day, the market is up when demand is greater than supply at that time for a particular market. If we find that there is an equal number of, unmotivated buyers and sellers, we have that equilibrium. And of course, supply is greater than demand, the market's going down for that time frame. This is something I thought was, I did this on Saturday live, and it was on about a 20-foot screen, I guess. I don't remember. And I put this screen together just because, the lady of justice that represents the United States justice system is, she's holding two scales and with a blindfold on, and she's not considering anything other than the truth. And basically, the justice is blind to anything but the truth is what it's supposed to be. So the buyers and sellers in our case is what we're measuring, and the volume weighted average price is what objectively tells us that message. I put a hidden message in here, and it was funny that no one could find it on that big screen. Now, some of you might have seen it because I tweeted it out later, but down here in this left corner, it says price action is blind to the bullshit. And it truly is, because so much of it is actually just that. It's bullshit. It's, Bob Pisani coming on to say that, the market's up because some hedge fund told him this or that, and he doesn't know. It's supply and demand, and that's what we need to focus on. So when we look at, what the volume weighted average price itself is, the traditional volume weighted average price, the one that you hear JJ talking about, when he's talking about, buying for a client or selling for a client, that it was an institute originally in 1988, developed as an institutional benchmark, something to compare price to, that said, how good of a job did my order get executed? And it's basically defined as the average, the price that a naive trader could expect to obtain. Now, that basically says, if the stock trades 3 million shares a day and JJ gets an order to sell 500,000 shares, he's going to do little tricks to make it so that he can, come out better than what the volume weighted average price for that day was. So if the stock traded, the volume weighted average price was at the end of the day $25. And if JJ comes in and says, hey, we sold your stock at $24.90, they're going to say, hey, brother, come on. What are you doing over there? That's not cool. You owe us. You got to make it up on the next one. Mm-hmm. But if he says the volume weighted average price was $25 today, I got your order executed at $25.15. The customer's thrilled. They're like, JJ, dude, 500,000 shares, you got us an extra 15 cents. What they probably don't know is he actually executed at $25.25 and took a dime for his firm so he could get a nice movement. Am I making too much up here, JJ?
No, well, giving away secrets, but okay.
Anyway, so that's how it started out. And it used to be that it was just, a market maker who would do this. And, people get tired, so they make mistakes. They're not at the desk the entire time. So it became the basis for algorithmic trades. And the way that a typical volume weighted average price order is executed today is that the firm that's executing the order simply says, the average daily volume over the last week, 10 days and 15 days, they'll put that together and they'll break it into time buckets. So it might be 30-minute increments, which there's 13 of, or they might put it in 15-minute increments. In other words, from 9:30 to 9:35, if the average daily volume is 100,000 shares, well, they want to participate in whatever the average daily volume is, let's say 10% of it. Well, they'll want to execute 10,000 shares in that first 5 minutes. If the average volume from 9:35 to 9:40 is 90,000 shares, well, then that executing brokerage will have their algorithm automatically participate in the volume at 9,000 shares for that time period. And at the end of the day, they've come as close to the average volume price for that day. So basically, when we use it as a execution tool, that's the way it's used. But what we are now using it for, and have been using it for a while, is a tool for looking at the market and analysis of price action to say who's in control. And the point is that initially it was for one day. Now we have the technology to anchor these volume weighted average price levels and put it from any point in the day, in the week, the month, year to date. We'll see that they're great on IPOs. So since an event, it could be an earnings report, it could be just a gap higher for no particular reason. It could be from the Federal Reserve minutes. Depends on how tight you want to get it. Again, it's, one of the components is time, and we all have different time frame goals. So it's the most subjective. Maybe you only want to look at it from the year to date or from the earnings reports, and that's fine. There's so many ways to the finish line in the market. My time frame, again, is swing trading. So I specialize in that, but I'm aware of some of the other timeframes, of course, as well. That's why I wrote a book called Technical Analysis Using Multiple Timeframes. But the point is, you can use it on any time frame because it often acts as a hidden level of support or resistance that you wouldn't see using any other technique. So where we anchor it is, like a lot of analysis, that's the subjective part. There's the technical analysis, which is the the science of looking at money flows and that. But then there's saying, the trading, the art of trading. The way that, again, we're looking at a daily volume weighted average price, it starts that first average price from and here, this is a 1 minute chart, the very first minute of the day. So as that first minute is calculating, you'll see that it'll be a dot, it'll be bouncing up and down. What it's doing is it's telling you the volume weighted average price for that minute. Once that minute is over, that blue dot gets locked into whatever that level is. And then it starts building throughout the day as more data comes into the picture. So obviously, when the price is rising and prices are above it, the volume weighted average price, demand is greater than supply. And just the opposite, if the sellers are in control, here's a market that gapped up, buyers were in control for a little bit, and then the sellers came in and they defended it throughout the day. And you'll see that often, in particular in the very short-term timeframes, that it is precise level of support or resistance. I mean, it's kind of scary how often you see it happen, even on longer-term timeframes as well, which we'll study as well. So I put this together last Friday, and this was this was Thursday of last week. The NASDAQ gapped up, so buyers were in control. And that very first point of control here, you can see the slope of the volume weighted average price was higher. It digested those gains a little bit and bounced. And these are, again, 2 minute candles. And then the market kind of went sideways. And what do you think is going to happen to any average when the data becomes pretty much all the same? It'll turn that average sideways. As the market breaks below that volume weighted average price, it says, hey, wait a minute. Now the average participant from that very first minute of the day, or 2 minute candle, is now losing money. It doesn't mean the guys who bought down here or in here are losing money, but the average weighted by volume, the actual dollar cost average, is now losing money. So the market then drops, the volume weighted average price starts to decline. And here's what we see. When the price is above a rising volume weighted average price, you generally want to say the buyers are in control, it's innocent until proven guilty, and don't take short trades. Now, that's for momentum trading. When it starts to turn sideways, you say there's no edge. I'm going to wait for a break of range. It breaks to the downside, and maybe you didn't get short right away, but it rallies up, finds resistance near that. Certainly shorting as it starts to break down with a stop above there is a good way to look at it. And you can say, well, that's hindsight, and we can say that about any analysis because the market's closed, but you see it happening all the time, and these concepts apply to every single time frame. So just generally speaking, the things we want to look at is where is the price in relation to the volume weighted average price, and what's the direction of the volume weighted average price. When the VWAP is rising, it says there's a positive flow of money into this stock for the time frame since this study began. If it's declining, there's a negative flow of money from the point that this study began. And if it's flat, just says it's neutral. There's no edge here. Why bother? What we often see is, and here's a year-to-date volume weighted average price that started on this stock on January 1st, or, it's often January 3rd or 2nd, whatever, the first day that, coming into 2021, I think this was 2021. I don't remember when I made this one. The sellers were in control here. It looked like at least those last 3 days of the year, but then buyers came in, and as the average, it came down towards that average price, you can see it was bought 3 times, 4 times, very, very clearly there were buyers defending that level. That level often becomes a reference point for some of these large pension funds and hedge funds and mutual funds, the biggest money out there, saying, I'm in the oil sector. I have to do at least as good as the oil sector. So when it comes to April and the stocks, are all above the volume weighted average price levels, they kind of go on a buyer strike. Their fund needs to, buy these stocks and participate. So it comes down to the average price that it was at that year. So we got to pick up more in here because we have to at least beat the average. And so far we're behind. So we have to buy as much in there as possible. And then as things start to switch, you see, the VWAP flattens out. And like any level of support or resistance, the more often it's tested, it gets weakened, and then leaving it vulnerable to a change in direction. This case, I don't remember what happened with this one, but it would just, kind of turn sideways, and definitely would need to put you on alert that things are possibly breaking down in here, that, you should at least probably stop out of your longs and maybe looking to get short. So when we look at the anchoring bias, what does that mean? It's, Daniel Kahneman came up with this. He won a Nobel Prize in psychiatry or psychology based on, investing psychology. Basically what it means is, the last price that you see or most recent one that you have is what gets anchored in your mind. So if you're driving down the street, you have no idea what the real estate is, and someone says, hey, what do you think this house is worth? A lot of people think it's worth $500,000. Well, you've just been anchored on that $500,000. So people will that's why people like sale prices, because we get anchored to the retail price. And then we hear something lower than that, we're thinking, hey, that's a deal for us. So what happens is they studied this, and that, if you gave out the number, hey, what do you think the real estate is worth in this neighborhood? And you said a lot of people think it's $500,000. You're typically going to get the question, if you have to ask 10 people, 9 of them will be clustered between 470 and 520. If you took a different group of 10 people and said, a lot of people think the average price that the real estate in this neighborhood is worth 600,000, you're going to get answers that are close to that anchor price. They'll be 575 to 630 or something like that. So there's things that affect our brain that we're not always aware of. The way to think about the volume weighted average price and what it really is, it's the average price paid over a period of time. Everyone's probably heard of dollar cost averaging. So we're talking here about, this was Apple, and I put this together a year ago. There's no point in updating it because this concept is the same. But when Apple was at $199.23, if you bought $1,000 of that on January 15th, that would have purchased 5.02 shares. Well, the next month, the stock dropped to 191, let's just call it. Now you bought 5.24 shares. You bought more shares because the price was lower. Now your volume weighted average price, your dollar cost average, isn't 199. Now you've averaged it to 195. All the way over when the stock is 235, now you're only buying $4.25 shares with that same $1,000. And your dollar cost average, that's the number that the government wants you to report to them. What is your average price paid? If you sell it at 235, your average price paid is 206.60. They don't give they don't care about what you paid each individual one, but how much are you making so they can take their cut. That's the volume weighted average price. It's the simplest way. And I realize I should have switched that. It's not APPL, it's AAPL. I thought I switched that on the slide, but I guess it didn't take or whatever. So it looks like a moving average. It's, we think of simple moving averages, exponential moving averages. Someone out there is out trying to convince people it's not a moving average. It's an average price that builds over time and it moves. To me, that's the definition of a moving average, but it's the dollar amount is what we're looking at. And it's very similar. The psychology is, why does everyone have a 50-day moving average on their chart? Basically, because they're told to. There's no magic to 50 days other than the fact that so many people use a 50-day moving average that when the stock is, 3 standard deviations away from it, short sellers start to come in and they say, hey, this is up too much, let's short it. And long funds start to say, hey, this is up too much. Let's stop buying this stock. So you have more supply and less demand. The stock moves down. And let's say that mutual fund owned 8 million shares and they sell 3 million into this upward movement. Well, and then they say, hey, if it drops back to the 50-day moving average, let's bid for 500,000 shares to support this stock. The people who shorted up here say, hey, there's often support at the 50-day moving average. Let's cover our short in there. And then sidelines cash say, hey, there's often support at a 50-day moving average. Let's stick a bid in. What happens, what's really happening is it's just a shift in supply and demand. There's less supply and more demand. It's not always going to work. And instead, when it breaks down and catches people off guard, the next time it rallies up, those same people are saying, oh, shoot, it's back to the 50-day moving average. Let's get out. Let's reduce our exposure. And you have to think of the psychology of it is what you really need to think about all the time. So the question is, what is the anchored volume weighted average price and where do we anchor it from? Keep these points in mind as it says, as we progress. One, price is the only truth, only price pays. These are the laws of supply and demand. They're not the theory of supply and demand. It's not, someone wrote a paper about it. It's the laws of, they call them laws of supply and demand because that's the way they work. And the volume weighted average price, regardless of where we're measuring from, gives us the ability to measure who's truly in control, the buyers or sellers from any point in time. That's what we're looking at. So again, the direction of the volume weighted average price, the slope of the volume weighted average price, and where is the stock in relation to that volume weighted average price. What we're going to talk about a lot here is the bottom point here is it a level of interest or a place to do business? A lot of people will look at a 50-day moving average and say, I'm going to buy at the 50-day moving average. To me, I think it's more of a level of interest. We want to look at it on a shorter term time frame to see if the buyers are starting to step in. So I don't necessarily want to do business at these levels, but I want to be aware of them. One thing I always have on my charts is a week-to-date volume-weighted average price. I started on a Monday and I leave it there. I also have a month-to-date. I have a year-to-date, but we're talking about the weekly right now. And this is through last Friday. This is the NASDAQ 100, the Qs. September 20th, the market gapped down, and that's what's kind of kept us in this funk since then. Anyways, it gapped down, and that first day of the week, prices held below it. And then on Tuesday, it gapped up, it came back and tested that. At that point right there, that was the second day, that becomes, now it's the 2-day volume weighted average price. Then it's the 3-day, the 4-day, and the 5-day. It's simply because it's measuring 1 day, then 2 days, then 3 days, 4 and 5. Over here, the red, now that becomes the 6-day moving average, volume weighted average price, the 7, etc. But anyway, so, sellers came in, but the price was lower, but buyers were in control. However, the next Monday, we had another gap down. It held that volume weighted average price from the prior week on a couple of occasions that day, but then it gapped lower. And now this second week volume weighted average price became resistance throughout the rest of the week. And that, of course, was was following closer to price, because over here it represents 5 days, whereas the red one now represents a 10-day volume weighted average price, 2 weeks. On the third week, last Monday, we gapped down again. The sellers were in control that entire day. Tuesday, it gapped up, and it ran directly into the volume weighted average price from the prior Monday. And then again, and on and on. So you start to see when you look at multiple time frames, and this could be a 1-minute chart, and this is 1 day, this is 2 days, and this is 3 days, and you will see these types of relationships develop over and over again. So again, this is through last Friday. One thing that I always have on my chart, as I said, is a year-to-date volume weighted average price. January 3rd of this year, market opens, buyers are in control in applied materials. It breaks below that volume weighted average price, but the volume weighted average price, it only closed, I guess, 2 out of 4 days in there below it. but the VWAP was still advancing, just starting to turn sideways. But buyers rescued it, ran it up, made a higher high. It pulled back again. And again, is it a level of interest or is it a place to do business? If you're just buying, right here, it looks like, well, it would have been good enough, but you felt like a kind of a jerk. If you bought it right here at 101, I would feel like a jerk right here at 94 and a half. 3 days later, I would have spit it out and saying, why do I always buy it? That stupid thing. Instead, I'd much rather buy right here at 104 and get stopped out somewhere up along, in that 110, 12 area. So to me, it's a level of interest to look at on shorter term timeframes. When you look at it, though, through last Friday, clearly I should have put an arrow here and an arrow here. I don't know why I didn't. It would have looked a lot more dramatic, but you see that, buyers show up sometimes almost to the penny and rescue it. And now we're kind of right there on it again. So does that mean buy it? Not to me. It means look at it on a shorter term time frame, and we'll look at AMAT if we have time at the end. BLNK. Everyone loved these EV, charging stocks, anything EV at the beginning of the year. And the buyers were in control for a while. Then it started breaking down, and the volume weighted average price from the beginning of the year was declining as sellers clearly were in control. It was up for the year on this day, but the average participant was losing money from that point. It came way down, rallied up almost precisely to that year-to-date volume weighted average price. And someone said, hey, this is a great place to unload a shit ton of stock. It comes back down. You get all these people excited. Hey, there it is. Look, it's going. Battery technology, isn't that awesome? No, it's right at the volume weighted average price. Let it digest and see. Otherwise, boom, it just got smashed again. Same thing with Nike. Nike came down. Nike gapped up here. It looked like it was holding. So here's where we're combining a couple of them. Nike gapped up on earnings. The buyers were in control. It came down and tested it almost to the penny after this little pullback, almost to the penny from that gap. And then it just rocketed higher, 155 to 175 in 3 weeks. Huge move for a stock like Nike. Then it started breaking down. So when we see it starting to break down and making a lower low like right here, that's about when I would say, okay, that at least near term looks like an important high. I don't know if that's going to be the high. I don't know, if maybe it's just going to come right back up through that. But as long as this volume weighted average price is declining, the sellers are in control from the highest point. I'm going to wait for it to, kind of flatten out before it starts to turn, before I buy it again. I don't want to buy the dip. To me, one of the most annoying phrases that's popular is buy the dip. Don't buy the dip, because a lot of times they'll just keep dipping and dipping and dipping and even crashing. If you bought it at, the first dip to 165, yeah, you felt good like over here at 170 3 days later, but how did you feel at 145? I can feel like a complete jerk if I buy up there and I'm still holding it. So as with anything, risk management is, we always have to have stops as well. BNTX, this is one of the mRNA related, the virus, what am I trying to say? Vaccine related stocks. Huge year for it. It started coming back down, and look how the sellers kept emerging at the volume weighted average price from that peak. And again, when do you set that volume weighted average price? To me, you see this big reversal from 450 down to 350, tells me that is pretty important. So I'll anchor VWAP off of that. And on bounces, do the sellers come back in? And in this case, yes, they did. And then they break support. And where do they go? Did you buy the dip here? If you did, or here it's, hey, it's on sale, it's a gap, it's, it's down at 275. Well, then it gaps again. And now it's at a level of interest. It's the average price since the beginning of the year. Anyways, on this Nike, it's kind of maybe embarrassing. I don't know, but I put this on October 1st on this day right here. This is an actual tweet. I said, it's interesting that it's dropped down to the rising 200-day moving average. That's blue line. And the year-to-date volume-weighted average price is the orange line. And it's also, if you take the low from this big move and you put a Fibonacci on it, it came right down to the 61.8% retracement. So there were three things in there saying, Maybe there's going to be less supply. Maybe the shorts are going to start to cover into this area. There's a group of shorts that might have been targeting that 61.8% retracement. There's a group of shorts that might have been, targeting the year-to-date VWAP. There's another group that maybe was looking at 200-day moving average. And maybe that's where the institutions were also similarly aligned. So when we have multiple things come together in that area, it kind of strengthens it. And I said, I'm not a buyer here, and I didn't buy it. And a couple of days later, it was 152, and I think it's up at 155 today. The point is, it's a level of interest. I don't know if you guys have seen, Boston Beer Company talk about buy the dip, 1385 or so down to 500. It went under 500. And last week, where did it touch? Right on the volume weighted average price from the beginning of this movement, where we saw the stock started to rally in July of 2017 from this important low 4 years ago rather. And look at it, touched there, buyers came in. I could put an arrow there, but it wasn't as precise. Another one here. And these things, it's not a coincidence. If you think it's a coincidence, then I got a bridge to sell you, I guess. I don't know. Pinterest, same thing, down to important low for VWAP from a low. And if you look at stocks that have, had big runs, and, we all know these names like the Stratasys, it's 3D, it's got a sexy story. People are interested in this. They remember earlier in the year how it went from 20 to 55 and they want to buy the dip. And look at how the dip buyers have done. They got smashed. And if they don't scare you out, they'll typically wear you out. Anyways, it gets that first big bounce. And where did it halt? Almost precisely right at the volume weighted average price from the peak. So let's say you're involved over in here. It's $22 per share. And you look at it and say, hey, it's got some momentum. It's got big volume. People are talking about it. I see in my chat room. I'm going to take this stock here and set my stop under there. And if it keeps going, I'm aware of this level. And that's a level of interest on the upside that says if it gets there, that's the average price from the peak. There's a lot of built-in psychology of people saying if they were dollar cost averaging, hey, now I can get out even. And the programs are built around this as well. Here we're running up to it again. And I think we kind of hit it the last day or two, and we're getting closer to the year-to-date VWAP. It doesn't mean it will halt it precisely like it did here, but you better be aware, like we were aware in when VERI made this big run up as well. These are two unrelated stocks. So gaps cause, gaps are a great place to measure, to anchor your VWAP. And all we're doing is we're saying, okay, there's a shift of psychology as far as the worth of this stock. I don't know what happened there. Usually when they gap up the individual stocks, they these big breakaway gaps like this, it's typically earnings. So in Altesian, whatever you call it, it gapped up probably on earnings. It went sideways for a little bit. And look at how, it kept closing right at or above the volume weighted average price from that gap. The first day there was a little bit of profit taking, goes back and forth. And don't just buy it there because sometimes it dips under, but combine it with, hey, there's resistance. I want to buy as it breaks past resistance with my stop under the volume weighted average price. And maybe you're still raising your stop under the volume weighted average price. So all we did here is on the left, we have the daily chart. On the right, there's a 65-minute time frame just to give us more perspective into this movement here. Palo Alto Networks, same thing. The buyers took control on this big gap up, most likely due to earnings. It came down and the buyers still maintain control of this stock. Skin, health, beauty health, whatever it's called. Same thing. It gapped up, pulled back, tested that VWAP, tested it again. Now, is it going to test it again or is it going to break through? I don't know. I certainly don't know the future, but I know that if I decide that I watch it in this area, and if it breaks right through it, no big deal. I'm either going to be stopped out if I was long, or I want to see it turn sideways, start to move higher, and then set my stop under there and be really aware that this is an important inflection point. This is the average price since the stock gapped up there. So there's a lot of, connected emotion, people saying, price has memory. There's a lot of memory there. And I know I'm not supposed to do this when I present, a tool that is great, that I love, but you know what? Nothing works all the time. You're not supposed to show losers, right? But when this one gaps up, the buyers are in control. The volume weighted average price is rising. It breaks down through it. Now, what that happens when it breaks down through it and it starts to decline, it says the average participant who bought after that earnings report in that 3-week period, the average participant is now losing money. Well, guess who knows that? The short sellers know that. Some of the institutions say, hey, we've got a bunch of this thing. We need to lighten up. And again, it's psychology. Now, will this volume weighted average price act as resistance, or was this a shakeout? It'll rebuild and go. Again, I don't know the future, but if I'm interested in buying this stock, I will wait for it to rebuild, hop above that VWAP, hold it as support, and show me a low risk place to enter. Merck had their pill news. Now, this was again through last Friday. And, after the second day, the buyers defended it. It looked like maybe it was going to be a shakeout, but the volume weighted average price was still declining. I think the stock's down near 79 now. So the average participant who bought because of this pill is losing money. Who sold to them? Who cares who sold to them? The point is, there's sellers. They're more powerful than the net aggregate of buyers. So gap down, buyers regain control, and then an earnings report comes in. We anchor it to that earnings report. Look at how well the stock held. And then one day little shakeout, and then another, this is 3 months later, another earnings report. So we anchor it to that one. And guess what? Look at how that one became, and this is great for risk management, is that, again, the psychology shifted from here. We had a shakeout. The buyers regained control. They defended it in here. So what do? We anchor another volume weighted average price to where they gain control, and we trail our stop up under that if that's how you're using them. So you can use them for risk management as well. Everyone has the same exact starting point in the publicly traded market when an IPO comes. That is, unless you got actual IPO shares, and if you're looking to buy a stock as it comes public, there's two things. And here's a 1-minute chart. You can anchor it from that very first candle right here, and you can see how prices were delayed behind it. Look at how big the volume was because the denominator, the number of shares, was so massive compared to the numerator, the price. It was slower to move as new volume came in. The second minute, though, if we anchor there, and this is important little, if you're day trading the first day of an IPO, always anchor it from the first minute, but also the second minute. The second minute is the actual true trading of the stock. The first minute is all just negotiated prices. See how it opens there and there's just one price level basically? Well, it's the market maker, the specialist, matching all the buys and sells. Everyone who wanted to buy on the open is buying it from all the people who wanted to sell on the open. So it's a negotiated price. The second minute is where it really starts to begin its actual trading. And look at how that became the exact place where buyers stepped in on that first day. And then if we come in and look at, here we are 3 days later, the volume weighted average price from the IPO, it opened on that and just continued to ramp higher. 6 days later, there's that volume weighted average price. We anchor to that. Here's where the sellers took control. It came down to the VWAP from the IPO and then kind of got stuck under it. These were some recent ones that I put on October 5th and again through last Friday. When we look at these 4 recent IPOs, none of them are connected in any way that I'm aware of. DUOL, DLO, DOCS, and IS, they all came down and tested that VWAP. And I said, I don't know if this is a buy here, but in the first one, DULO, it dropped down a little bit, but then buyers regained control. It dropped down slightly. It was actually already through it, but buyers gained control there. Buyers gained control in DOCS, and it came right back down. So it kind of failed. I mean, there was a quick trade in there if you wanted it. But what I ought to do is put a volume weighted average price off these peaks as well but that wasn't the point I was trying to make. Here are four big ones that have, been in the news and that. Peloton came public in 2019, traded underneath the VWAP for a little bit. Buyers gained control. That's a big rally in there. You can't tell, but percentage-wise, it was. Had a shakeout, then the buyers gained control. Earlier this year, it came down precisely that VWAP and bounced from 84 to 84 up to 130 or so. Now it's down there again. Is it going to be a buyer again? I don't know. I'd rather buy right here and set my stop under there than buy here and just hope and guess. Same is true with Teladoc. Teladoc came public. Buyers were in control a little bit, underwent some distribution and stayed under the volume weighted average price for over a year. But then buyers took back control. And here we are. We're bouncing somewhat. I think it's about 135 or so. Zoom. Who knows if that's going to hold? Is that trend over? How about Zim, the shipping company? So when we see an IPO, it often acts as support. Well, it can also flip and act as resistance, just like traditional support broken tends to act as resistance. And it's mainly psychology. So again, through last Friday, this was Bitcoin and some of the key volume weighted average price levels here. This Bitcoin began a big move in August, or I guess July of 2020. And look at where the buyers came in at that 30,000 level, defending that. The year-to-date volume weighted average price. Look at how after it bounced from that VWAP from 30, it ran right up to that and then came back down. Came back down to where? The momentum began here, so that became where the buyers stepped in. Over and over again, you'll see if you anchor them to the correct places, and it occurs, through the process of trial and error. Where do you use that? Where do you break? Where do you anchor them? Breakouts and breakdowns, the open of the trading day, significant highs and lows. I love using like the high of the last month, the low of the last month. If there's significant lows, if a turning, where the momentum turned back up or down. Earnings reports, FDA, year to date, week to date, month to date. They're great for identifying where the shorts are located and their average price. Gaps, meaningful highs and lows, like I said. Any significant movement where you can identify there was a shift in the supply and demand equation that caught a lot of people off guard, or we have a new valuation, a new regime of, are the buyers in control because the sellers were previously in control, or vice versa. We want to know the psychology from there and move it from that point. So the most important thing, this slide over here on the left, actually that's the second most important thing, but only price pays. So we have to have risk management. Risk management is always job number one. Anyways, I won't mention, my book, these guys talk about it, JJ and talk about it all the time. So thank you for the opportunity to share this with you. What I'm going to do right now is I'm going to share TC2000, and I'll just put that on there while you have any questions. And if there aren't, then we'll just talk about, some stocks in the market. But I kind of didn't expect it to be that close to 45 minutes, but it's perfect. So we've got some time for questions. I'll just shut up for a moment.
All right, perfect. Thanks so much, Brian. We got a bunch of questions. Appreciate everyone submitting them. They kind of start off as general questions, and then if you guys have, I guess, like Brian said, any specific stocks you want to look at, I guess we can get into that if we have enough time. So Brian, first question. Which time frames are more important, daily, 5 minute, et cetera? And is there some minimum or max slope value that could be a threshold?
That's a great question. It depends on time frame, what your personal time frame is when you're trading. So, for me, I like to keep, for swing trades. Now here, this is kind of a mess. I apologize about that. But we've got some important volume. Here's the volume weighted average price in the S&P 500. I think that everyone should be aware that the volume weighted average price from that peak has been acting as resistance and is still declining. To me, that's important. We're also below the volume weighted average price from this significant low and this significant low. And you can see that's that purple one, that's also declining. From this low, it's also declining. And we also have the declining 20 and 50-day moving average up in there. Here's our year-to-date volume weighted average price. So in other words, when I'm looking at a daily chart, am I trading off of the daily chart? Not really, but I want to be aware of the bigger picture, who's in control. So on my swing trades, I want to look down to a 30-minute time frame and say, for instance, here's a stock I'm short. It's not doing anything for me yet, but CGNX, the volume weighted average price from that low, I want to be aware of that, even as a swing trade. And then this low became support. So that becomes an area where if the stock can, in fact, drop significantly, I think it can drop down to here, this 76-ish level. And that's not significant, but for a swing trade, that's kind of not really my target, but an idea of where it can go. The volume weighted average price from here, you can see the sellers are in control. So we go back on a daily chart and say, from this low right here, look at how the buyers defended it again right here, and then it flattened out, it broke down through it. Now we've got this little flag or triangle, whatever you want to call it. So we look at that and they say, let's go to a 65-minute time frame. What about the volume weighted average price from the peak or from this momentum lower? So I want to anchor it here, and you can see, looks like from this real momentum lower, the sellers are safeguarding it from going back up above there. And what about from this most recent low? Who's in control? Looks like the sellers are trying to gain control. So it depends on what are your objectives here. What's your time frame that you're looking at? And for me as a swing trade, I want to be aware of the bigger picture, but work down and say, okay, now now that I'm short this thing, I got short 2 days ago, right around in here. And my stop was originally right here. I'm thinking about lowering it to above today's high. So it depends, on how you identify yourself. Are you a day trader? Well, you've got no business looking at a monthly chart of the VWAP in Peloton. Why would you need to know this as a day trader? But if you're a swing trader saying, hey, I've been looking to put this in my portfolio, or a longer term investor saying, I've been looking to put this in my portfolio, you don't buy it right on that number, but maybe as it's starting to come back up from it, then you look down to the 30-minute time frame and say, okay, well, here's the most recent significant big high. If it does start to get going beyond this level, where is it likely to encounter supply that will at least slow it down, I think, at that volume weighted average price, so we can use it to help our risk reward as well. Anyways, sorry, Ray, for the long answer.
No, that was great. No, that was that was awesome. It made a ton of sense. Shout out to Iron Lungs. Thanks for the question. Next one we got here from Midas. He goes, how do you determine whether to use the middle price of a bar to launch the anchor versus the high or low of the bar? Is it just an eyeball test?
It's not really going to make much difference. They're in the same area, but so in other words, I want to know, the psychology shifted here on this on Peloton this day. So the buyers were in control from there, but clearly, they defended it, it flattened out, then they lost control. So at this point, all I'll do is say, from that peak, the sellers are back in control, or from this gap lower, look at how the sellers have been defending that. So if they can get back above here, perhaps it runs up to there and then pulls back and either goes up or lower. But the point to answer the question specifically is that the actual volume weighted average price can only be found with a tick chart, where you take every single transaction, every single unit of volume. But the second most accurate is the one that I use, which is what you're looking at when you look at a 1 minute candle. And if I want to say from here, what's the volume weighted average price? Well, that first one, you'll see where that dot is. That dot is the actual VWAP from there, and it's determined by open, high, low, close divided by 4. Some people will use just the closing price or just the opening price. I think you want as much data as possible, and when you're estimating that, It's the open, high, low, close divided by 4. So from this point right here, from this low right here, it doesn't matter what the time frame is, and it doesn't mean it's always going to make sense. But when it does make sense, it definitely gives you a huge advantage to say from that point, the buyers were in control first thing in the morning in Peloton today. But guess what? They lost control very quickly. And I don't want to be involved in this stock. If I bought it this day and the average person is now losing, I want to do better than the average. So I'm going to sell my stock to them and either take my very small loss or a very small gain, but move on because I don't want to be involved for this nonsense where it drops 2 points in the next 20 minutes.
Excellent. Yeah, and I think this next question, I think you may have touched on this, but he's like, during a trend and hierarchy of lines, when do you determine that a particular line is no longer valid and shouldn't be further considered on the chart?
That's a good point. The hierarchy is this, that similar to a trend once established is more likely to continue than reverse. One of the tenets of technical analysis. I think you have to say, defer to the, in Peloton, this is continue to use Peloton. If you're an investor, maybe you're saying, I need to add more shares here. This is the average price. What a unique opportunity for me to get back involved. I look at it and say it's below declining 20, 30, 40-week moving average. Money's flowing out of this. To me, it's more likely that it bounces from here and then just gets the shit kicked out of it. But is this longer term important to your decision today if you're a day trader or swing trader? Not really, but it's worth being aware of, I guess. So, I'm a shorter term trader and I'm aware that this is potentially a bigger inflection point. It's kind of the same question of, what's the hierarchy of when do you look at a weekly chart? And I'm a day trader. I never look at them and that's fine. It's whatever works for you. But I think we generally want to be aware of what the bigger picture is and key levels that have made sense to a large number of participants in the past are worth at least being aware of because price has memory. And if we come back to that place where there's a lot of price memory, it might motivate buyers and sellers again. So I want to be aware that it's in that general area.
Yeah, it makes total sense being aware of the big picture. Absolutely. Thank you, Midas. I guess for me, Brian, I guess maybe not so much of a question, but I love Daniel Kahneman. You brought him up earlier. Have you read his new book, Noise?
I have not. No.
Okay. If you like him, I would definitely recommend it. Excellent book. Just on like system noise. And I think it applies 100% to trading. And he goes over different studies and stuff like that. But
that's fantastic. I mean, look at how much noise is in the market. It's nothing but noise, which is why we try to distill it down this way. Right.
Yeah. And it's amazing not to go down this path, but they've done studies on people trying to predict, like prediction studies, and just how bad human beings are at prediction, and even people, quote unquote, experts, especially experts. So I just thought that was fascinating.
Definitely, right?
Yeah. Absolutely. All right. Next question. Thanks, Midas. Shout out to Midas for the questions. Next one. Do you use indicators like RSI or CCI to confirm reversals when price gets to VWAP?
I don't. I simply move down to a shorter term time frame. So, for instance, as I spoke about Stratasys, I want to be aware that the volume weighted average price off that peak held was where sellers showed up again. It doesn't mean a place to do business for me. Instead, I want to look at it and say, all right, well, here's the week to date volume weighted average price, and here's where they really gain control. So if if the stock comes down to here and bounces again, but then breaks, that's my confirmation. I don't have any problem with anyone using any indicators like MACD, stochastics, RSI, CCI, etc. Early in my career, I used to look at it, I've studied them all. At some point, I've been doing this full time since 1991. So, we're all curious and we all want to crack the code to the market, right? So we keep looking at every indicator and oscillator. And every time someone brings something up that seems to make sense, we try to validate that and see if it makes sense to us. I like to keep my charts as simple as possible. And the older I've gotten, the more I realize it is truly just a supply and demand game. And the anchored VWAP can tell us better than anything else with objectivity from this exact point right here. The average price is $25.76. How would I feel if I was short? How would I feel if I was long and it broke down below that? How does the crowd feel when this happens at this point? Most likely similar to the way they felt, when we isolate this little rally and say it began here. Well, the average price from this low, and I didn't anchor it properly, but from this low, or even from this candle, the ignition candle, that's probably the better place to measure. The average participant was starting to kind of feel a little bit dumb right there. And you don't have to wait to go back to, where it started to get out. Lock in whatever you have. We pay 0 commissions. If this volume weighted average price from the beginning of that move is starting to turn lower, the average participant is getting out of this thing. It's time for you to move too.
Awesome. Shout out to Too Much Sauce for the question. Thank you. Next one. Any advice for lines on a 1-minute chart? They can be pretty finicky.
If you're a day trader, look at the volume weighted average price from the open. It starts to get, again, what's the direction of the volume weighted average price? It's higher in here. Then it starts to turn lower and sideways. And then it breaks support right here, and the VWAP is lower. So, you look at the SPY, for instance, or, what I'll often do, let's say on a 1-minute chart, is I'll look at today and I'll say, what's the average price since the open? Well, the sellers came in and quickly gained control here today. So I don't want to be a buyer when they're just spitting this stuff out. It comes up to the average price for the day. The volume weighted average price is still declining. I'm looking at maybe buying above this level, but the VWAP is still declining. And then we get a shakeout. It runs up through it. It tests it. So now maybe the best buy of the day was right here. Not right. To me, I don't want to buy there. A lot of people like to. I wait for confirmation that it's pushed a higher high. And then I can say, well, what about the average price from the low of the day? Is that being defended? And this is what we see a lot, actually, is that it'll come if you anchor one from the low, and you would anchor it about right here. Doesn't mean it's going to hold, but you look at it and say, okay, is that the low of the day? Now it's kind of pinching between these. We have a shakeout. From that failed move comes this fast move. So, there's always noise on a 1-minute chart because it's real time, but there's also noise on the bigger time frames. It's just that you experience it so quickly on a 1-minute chart that you often don't have time to think about it and process it. And you probably shouldn't be looking at it. Actually, this is a 2-minute chart, I guess, that I'm looking at. But I hope I answered that question the way it was intended to be asked.
Yeah, I think so. These next 2 questions we have, Brian, are kind of they're related to futures, and I guess I don't know your experience with futures or if you could speak to it, but I guess kind of the differences to where where you would anchor VWAP on futures as compared to equities, if there's any difference.
No, not really, but and a lot of people don't have access to the futures, so in that case, you ought to anchor from at least the point of, post-market yesterday and pre-market today. So here's the VWAP from the post-market today. I think that if you're trading the futures, you should be aware of the volume weighted average price levels that are important on the daily time frame. On the SPY, as well as the futures. So look at, again, that gap down on the 20th. It became resistance and then support, and then it broke down resistance. We gapped up through it. Here's the VWAP from the gap higher. Was this last Friday or Thursday? I forgot. Anyways, money's still flowing out from there. But look at how this is our week to date volume weighted average price, and that's in the same exact spot as the VWAP from the 20th. and here's the volume weighted average price from the beginning of the month. So we're kind of clustering in an area where I'm thinking that if we're going to make a bullish run, it's going to kind of do it like this. But if it doesn't, and we continue like this, then, look out below, perhaps down again to test this volume weighted average price. So it's all about, what's your time frame? How deep does your analysis go? And how do the pieces of the puzzles from different time frames fit together?
All right. Thank you, Bobby, and too much sauce for the questions. All right. Next one here, Brian. He says, thanks for the presentation. Brian, what qualifications or skills do you look for when hiring for your team?
I don't have a team. It's got me confused with somebody else. I am a independent lone wolf, keep other people's opinions away. I've really, I'm when it comes to the market, again, I've been doing this full time since 1991. I've become totally self-sufficient. So I just rely on my interpretation of the market and my risk management skills.
Excellent. I think that was someone looking for a job potentially. Shout out to
They're not hiring.
Shout out to my man Ankit. Thanks for the question, bud.
Good question. Yeah.
All right. Next one we got here. Awesome presentation. He says,
thank you.
I'm wondering about using anchored VWAP intraday from fresh catalysts. For instance, let's say Apple gets some negative news during market hours that causes a significant sell the news reaction. Do you think that using anchored VWAP on lower timeframes could be useful for intraday traders who are trading the reaction?
Absolutely. Yes. 100%. If you follow me on Twitter, you'll notice around, when there's Federal Reserve meetings at 2:15, when the announcement comes out, we get that first, real volatile that nobody knows what it's doing. After about 10 minutes, you'll see that the developing VWAP that comes out of that, what started at 2:15 Eastern, at 2:25, it pulls back to it, and then it bounces. And it pulls back to that VWAP at 2:40 p.m. and it bounces again. And then it kind of goes sideways, and that VWAP from 2:15 starts to flatten out. It breaks below it, comes back up and tests it from underneath at 3:08 p.m. And then it completely falls apart the rest of the day. So I think it's valid for scalpers, for day traders, for swing traders, position traders, investors, everything in between. I've got a slide actually that, when if you guys remember about a year or so ago, in let's say maybe April, after the pandemic kind of, bottomed out, that Warren Buffett said, hey, I sold all of my airlines, and he sold them over a 2-day period. And if you look at the price that was reported, he got the volume weighted average price for those 2 days. I mean, it was the exact volume weighted average price. And that's because he hired Goldman Sachs or whoever, and they said, we'll take your order, Warren. We'll guarantee you VWAP. And then they took the market risk and went and executed it.
All right. Awesome. Thanks for the question, Fank. Hopefully I'm pronouncing that right. Good question. Next one we got here. Over the last 2 years, there's been an influx of novice/retail traders. Given price is a reflection of the psychology of market participants, have you noticed different behavior in the markets, and how do you anticipate this evolving over the next year or two?
I have noticed it, but I will also say that I've also noticed that it's amazing that the big programs will drive things back to those key volume weighted average price levels. I didn't trade it. A lot of people traded this CEI, and someone was asking me about that. And I said, if you look at where the move began right here, look at how well the volume weighted average price, held. And then from this move, you can anchor from there. It flattened out and began to turn lower. What I've noticed, though, to answer the question specifically, not just about, VWAP related, is that, it just seems like there's a whole, and I think this is why Renaissance Capital had their worst year last year and having a bad year this year, is that they, if you read the book about them, their main strategy was a reversion to mean. they had deep enough pocketbooks they could just sell short all the way up. But now we have these apes, and their YOLO trades that they just keep buying, and they have no common sense about risk management. And we're getting, bigger moves that last longer and seem crazier. And it just teaches, it just reinforces everything I know about the market is don't try to pick the top. Don't try to fight the trend. You can, look at the stock on this day. I mean, it opened here, broke below. There's volume weighted at, I can't, it's too long ago, but maybe we could do it like this. From this gap higher, the sellers came in, they've been in control, from this gap up. Look at how well the buyers held it throughout that day. It gapped up, it started selling off. So yeah, it has changed. I will also say the other thing I've noticed is that options premiums just always seem much higher than they were 10, 15 years ago. And it's got nothing to do with the volatility index. The volatility index kind of has the same readings that it has, but an option that was, let's say you're looking at a stock that's $24.20, used to buy a 3-week option for $1.25, with a 25 strike. Now they're like $1.85, $1.95. So people don't talk about that, but it just seems like options are more expensive. And I think it's because options volume has exploded so much that the premiums are going up without being reflected in the volatility index.
Yeah, it's really interesting. I mean, though, we had on one of the new market wizards in the book, Jason Shapiro, and he was saying like, yeah, he thinks things are just totally different from this year, I guess, since the whole Wall Street bets movement and out of like all the years he's been in the market. So yeah, it's interesting times for sure. Thanks for the question.
Let me just talk about that again, because in my career, one of the biggest shifts in the way the market was the race to zero in terms of getting your line into the New York Stock Exchange and having the quickest quotes, the HFTs, and what they did to the market maybe about 6-7 years ago. It used to be that nothing, momentum wouldn't run anymore because these HFTs were on every fucking move. Nothing would move a dime without some kind of shakeout. It was so infuriating, and one of the least profitable periods of my career when I felt like I knew what I was doing, but the market wasn't making money. I prefer it to be out of whack in this way, where we're getting these crazy momentum moves, and you hook into these stocks and can make 30, 40, 80% in a day. I mean, it's just insane. I'd rather have it out of whack in this regard than out of whack that volatility gets so compressed that nothing moves or follows through.
Thank you, Shavar, for the question. He originally had 3 paragraphs, so thanks for condensing it for us. Brian, really appreciate your time. I mean, we got a few more questions. I'll try and wrap this up. I mean, how much? You have a couple more minutes?
Yeah, I do. Yeah.
My man, thank you. Appreciate it. All right, this one's from Frank White. Can you give an example on how to use Anchored VWAP to possibly locate short sellers?
I would have to, let's see, so one that my dog's going crazy. It's 5:08 here, and she's used to dinner at 5 o'clock on the money.
All right, we'll wrap this up. Yeah, I know.
No, we're not going to wrap it up for the dog. I'm just letting you know if you hear background noise. So here's one that I spoke a lot about in Twinkie back here. I was talking about a short squeeze potentially coming. I'd have to really, unfortunately, I'd say search my name and short squeeze. But the shorts are getting squeezed in here, and I laid it out. They wore me out in here. I didn't end up participating in this. I didn't see this till last week. Someone pointed out, they're like, "Hey, you called that short squeeze? Good job." I'm like, yeah, whatever. But the way you typically see it is that you'll see the short interest reported every other month, and I'll draw it in underneath, and the short position you'll see will kind of like grow as the stock goes up, and then maybe they get a little bit more aggressive because they think they're getting it under control. And this is, maybe 1 million shares, 2.3, 2.8, 5.6, and then, 7 point, and then you'll start to see it breaks out. And there you have evidence of it. So what I like to do to get to this question is to say, all right, if they added, let's say it went from 3 million to 8 million here, I know that they added 5 million shares into this move. Well, what I want to know then is if I anchor the volume weighted average price there, what that tells me, that's that purple line. And I'll know that if they went from what I say, 3 to 8 million, the volume weighted average price during that time was 1575. So that tells me the average short of those, 5 million shares is short at 1575. So when it breaks out, they're feeling pain. So we can, and then we can say, well, on this month, it was really, and during this 2-week period, it was really significant where they increased their short. So I'll say, well, during that time, the average price was 1625. So as it breaks definitively above 1625, all those shorts are underwater and they're more likely to, go in and either try to, hold it back, or at some point they lose control. The stock gets away from them and then they're forced to cover.
All right. Thank you, Frank White, for the question. Next one here we got from Stark, our friend in Japan. He asks, could you please talk about Wish IPO this year?
I think that there's a lot of people stuck in this and it's wishful thinking. It's one of the worst stocks there is. I mean, what a piece of shit, really. I mean, I'm sorry to burst your bubble if you're wrong, but
there's 300 million shares of free stock hitting the market every day.
And the average price since it came public is $11. There's a lot of people losing a lot of money. You've got a declining 20-day moving average it can't get above. You got a declining 50-day moving average. You've got a volume weighted average price from every single point you can measure that's except for this week, that's losing money. So, let's stop being just, I don't like to buy stocks in downtrends. Here's the most recent big move, and the average price from there and this low and this high is right around 650. If it can get out of its way, I would be aware of those levels, that it's likely encounter more supply in there. And I apologize for saying it the way I did, but I see people talking about this stock all the time, and I just don't get it. There's so many stocks that are going higher. Why continue to fight the trend? I mean, it's clear. People are selling this stock that have a lot more money, a lot more shares than anyone on this call does today. I guarantee it.
Yeah. No, I mean, sometimes I think things just need to be said bluntly.
It's tough love.
It's tough love, right?
It truly is, because if you'd rather hear the words in a tough way than just see your account balance continually shrink.
Yeah, absolutely. All right. I'm trying to wrap it up here, guys. No more questions. All right, we got to get Brian on his way. He's been gracious enough. There's two philosophies, and I guess this is pertaining to stops. Fixed stop before entry and variable mental stop on breaking the thesis of a trade. Do you have a view?
My stops are based on a simple thing. So, and that is the definition of trend. I got involved in CFL. I'm sorry, I was looking at a different symbol. LAC yesterday. Got back above this VWAP. I'm in 2/3 position, but I like to, if I enter right here, my stop is under there. Period. It's 2 pennies below that low. If the stock didn't work, I would have been out. Done. End of story. And I base it. Some people will say use 3%, 5%, 7%, and that's better than no stop at all. But see these arrows? These are actually where my stops have been risen up to, where I've raised them to. And currently I have a 2/3 position left. Half of my stop, my original position, my stop is underneath this little low right here, and the rest is under here. So to me, it's getting extended. I want one stop super tight and one below this day's low. It's about the definition of trend. as a swing trader to be involved at $22 and what price do I own it? Whatever, it doesn't matter. 22.05. I sold a third with a gain of $1.20 as it ramped up the first day. And now I've got 2/3 left. I've got my stops, like I said, right here and here. So it's about definition of trend. And once it starts getting extended, my definition of trend gets tighter. In other words, this is my most recent significant higher low because that was the main pullback today. And we pushed higher by, more than a point from there. So or about a point. I want to give it a little bit of room, but I also don't want to be a jerk and, sell all my stock down here and give it $1.50 and give up, 2/3 of my gain.
All right. Sorry, guys, if I skip some of the questions because we got to get them going. Shout out to I forget who asked that. Shout out. Thanks for the question. This one. Do you look at moving average crossovers and or anchored VWAP crossovers?
Good question, and I know a lot of, and I have a pretty strong opinion of that. In fact, I have a tweet that's loaded and ready to go. That I typed the other day because I was thinking of this. But moving average crossovers represent indecision. So when the 20-day crosses the 50-day, it doesn't mean that the market's going to go lower. In this case, when the 20 crossed below the 50, the market was already lower, but the 20-day moving average was declining. And as it crosses here, what it's saying is an intermediate term trend crossed below the longer term trend, and it represents indecision. So where does, is it an action point or is it something to be aware of? So if you use it as an action point, look at where it gave you the signal right there. That's the day it actually crossed, pretty much the lows. So it represents indecision. It's slow to respond. And it's to me, it's not an action point, but now this vertical line right here is where we were 50 days ago. So that tells me we're going to start averaging out next week, these 5 days, the week after that, these 5 days. So this 50-day moving average will be declining unless the market can get back up and at least match those days. And if it did that, that would be okay. If the market came up and held above that 50-day moving average, it would flatten back out again. And then it could, so you want to anticipate is my point.
All right.
Moving average crossovers are late.
Right. Got you. All right. Unless will be the last question we'll ask. Seeing Brian pull up SSYS. I'm interested to know if he can show the anchored VWAP from DDD highs in 2013. I think it would be interesting to see the memory of price from that massive bubble.
So 13 would probably have to go to a month. I wouldn't be surprised if we, halt it. Well, look at that. It's trying to gain back control. So that actually bodes well for the longer term that, again, if they didn't scare you out on the way down, they wore you out, and now the buyers have regained control for perhaps another big move, but it's still kind of squirrely in here.
All right.
But that's a good observation.
What that was. Shout out to Regan. Good observation, Regan. Appreciate everyone and their questions. Brian, thanks so much for your time, man. I know we had you on the podcast and I asked you a bunch about anchored VWAP, but like seeing it on the charts, there's only so much we could like really,
right.
It's a podcast form. It's different, and seeing this, I'm truly excited to, you to start playing around with this, maybe implement it into the way I trade. So I appreciate it. Yeah. Steve says, go get his book for sure, guys. Go out, buy his book. Brian, thanks so much, man.
Yeah, let me just say real quickly, the tool is becoming more widely available. You can get it on TC2000, TrendSpider. You can get it on the free version of TradingView. You can actually anchor it and drag it around. So when people tell me, hey, I use Thinkorswim and they don't have it. Well, stop being such a cheap ass and get if you think it's valuable, spend $30 a month on TC2000 or go to the free TradingView. It's out there. Don't be stuck to one platform just because that's where you execute your trades. Pull up your laptop, get on TradingView or something, or even Yahoo Finance has it. So it's out there. There's no excuse for not using it if you think it's valuable.
And all the members, everyone's thanking you. They really appreciated it. They enjoyed it
great.
a lot.
Thanks for having me on again. You guys are great. I really appreciate what you're doing for the trading community and keeping it real.
All right, Brian, you're the man. Have a good one,
Right.
man.
You too, guys. Thank you.
All right.
Good night.
All right. Have a good night, everyone.